All right. Today is Wednesday, February 1st, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy FOMC day. We will go over everything that took place today, and by the end, you will have clarity on what happens next. In the morning, we received the JOLTS data, which means job openings and quits. Needless to say, openings smashed expectations and rebounded to 11 million jobs. Now, recently, we have seen data indicating a rebound in inflation underway, and the JOLTS today confirmed all of that. Now, the market did not like this piece of data because it indicates that the inflationary process is still alive and making a comeback, which might make Jerome Powell and the Fed more hawkish and tighten the monetary policy even more. Now, heading into this FOMC meeting, the market was worried about Powell's take on two macro pieces of data: this JOLTS report and the loosening of financial conditions. Now, pay attention, because the key to the market's reaction today revolves around these two. Number one, the JOLTS. Number two, the loosening of financial conditions. But anyways, Jerome Powell came out with the magenta tie, meaning Powell the Dove was on the podium today. And he did what he did and he said what he said. We will dissect everything he said and why the market reacted the way it did in the In Focus segment. But listen to me carefully now. The people who felt good today will feel bad in the next few days, and vice versa, meaning the bulls who declared victory today will be shaken out, and the bears who got shaken out today will feel better in coming days. I'll explain in a minute. But here's what I said today. The FOMC is over. While Powell initially indicated ongoing rate hikes, quote unquote, his conference tone was more of data dependent. The market read this as, number one, ongoing rate hikes, that's a bluff. Number two, data dependent, mean this is the last rate hike and the pause, for all intents and purposes, is in effect. Now all eyes will shift back into earnings. I also added, stop stressing about what Powell said and did not say. This was a nothing burger at the end of the day because we know what's going to happen next, folks. Pay attention to earnings and technicals. SPX 4,228.5 long range target. However, short-term charts will trigger algorithmic selling due to overbought conditions absent of earnings, adding more fuel to the rally. Now, we know what happened after hours. We have Meta exploding higher, but that could be the climax. More on that in a minute, but here it is. I also added that for those who followed, I'm closing my TNA calls. That was the hedge in case Jerome Powell comes out dovish. It did serve its purpose today. I'm done with it. It's over. Now I'm going to focus on betting the other way, the other side of the bet, the contrary bet of what happened today. The reason is, when we look at the charts of the Qs from a short-term perspective, we see overextended momentum that will cause selling, no doubt about it. In other words, we will see the climax of the January rally by the end of this week. And this will happen by participants who did play the rally, booking profits from these impulsive pops. Now, I'm not going to speculate on what the catalyst will be for this climax. It could be Amazon popping higher tomorrow, for example, then bombing earnings, and that could strike fear back into the market now that the focus has shifted back into the fundamentals and technicals. And speaking of, the pullback does not need a catalyst. It could just happen based on technicals alone. Look at the VIX, for example. It's back at its support, and if I see the VIX moving higher in the morning, along with the market moving higher together, that will be my confirmation that my assessment is right. However, Jerome Powell basically gave the market the green light to close the gaps above in the weekly charts. So what I see is a pullback imminent, then dip buying resuming to push the NDX, for example, to close the gap at 13,242.90, which will be a gain of about 7%, and the SPX to close the gap at 4,228.5, which will be a rally from today's closing worth about 3% or so. Then we realized that Powell made a mistake by either inflation expectations rebounding or the CPI confirming a rebound month over month, and the rally ends. Sentiment shifts from the bear market is over and this is a new bull market to holy shit, the Fed has to do more. And oh, by the way, we have more layoffs, more debt, and more deterioration in the economy at that point. Now, your question might be, why would inflation rebound while the economy deteriorates? The weakness in the dollar that Jerome Powell initiated today will create inflows into commodities. commodities. That is called stagflation, and we have seen it before. Just look at the ISM manufacturing data that we got today. While the headline readings continues to collapse in contraction territory, yet prices paid smashed expectations by rebounding to 44.5 from 39.4 in the prior month. What we're seeing right now is stagflation. What we're seeing right now is economic activities getting weaker while inflation finding a footing and rebounding higher. And what Jerome Powell did today is adding more fuel to the fire in the upcoming rebound in inflation. Now, before we start, we revisit our scenario analysis, and I will show you why what we saw today was scenario number 1, not 3, even though on face value it appeared that what we got today is scenario number 3, and the market should have moved down. With that in mind, let's dive right into it, folks. And here it is, in focus tonight. Mission failed. Jerome Powell could not control the market today. What happened? Today, the chairman of the Fed, Jerome Powell, sparked a rally rather than tampering market expectations, as most expected him to do, including me. It seems as if Jerome Powell did not see a problem with the impulsive nature of the market rally so far, or the data suggesting a rebound in inflation is around the corner. I will break this conversation into 3 parts, and you will realize by the end why Powell failed to stop the market and instead gave it more fuel to continue to speculate higher. Part number 1, we call it ongoing but. Part number 2, the green light. And part number 3, what Jackson Hole. We start with part number 1, ongoing but. You see, in the beginning, when the statement came out from the FOMC, all eyes were on the statement that read ongoing rate hikes, meaning this is not going to be the last one. We have more to come. And the market initially went down. But this is where Jerome Powell negated the initial statement by the Fed that was intended to stop the market rally. Let's see if you can catch how Powell contradicted himself in a matter of seconds. Take a look.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases.
So right away, while he says with one side of the mouth that ongoing rate hikes are needed, he cancels that by throwing a bone to the bulls who've been complaining about the Fed over-tightening due to the so-called lag effect. By acknowledging the lag effect, Jerome Powell threw cold water on the previous statement, suggesting a need for more hikes. Why would you need more hikes if there is a lag effect from previous hikes that, by the way, moved you to reduce the pace from 50 to 25 basis points? Nobody will buy the ongoing statement now. On top of that, he also suggests that ongoing is an outdated statement from December, and it will be updated in March. Take a look.
Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%.
You see how he read that statement from a paper? It seems that this is what the Fed wanted him to read, just to tamper down the market's expectations. Just read that stupid statement of ongoing rate hikes. But in reality, it seems that he was just told to read this bullshit so he can avoid sounding too dovish. Again, nobody watching this, nobody listening to this believes that the ongoing statement, quote unquote, is legitimate. And remember Powell from November who said that the risk of over-tightening is less than pausing prematurely? Well, here's the post-thing Powell. Apparently the thing made him dovish again. Take a look.
Of course, we have no incentive and no desire to over-tighten.
Okay, so no risk of over-tightening anymore. He's not going to over-tighten. So why would you need ongoing rate hikes? Before, it seemed that he did not mind over-tightening by a bit. Now, he actually thinks that we are already at the restrictive rate. Take a look.
But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
So he confirms policy is restrictive and rates are positive too. So mission accomplished. Inflation is dead. No need for ongoing rate hikes. That's what he basically said. And of course, the moment the market listened to this, okay, so the ongoing bullshit was just bullshit. He's basically telling us to go ahead and rally. And that leads us to the green light part. Now remember what we said in the intro, that the market was worried about Powell getting mad that financial conditions have loosened and jolts coming out hot? Well, Powell doesn't seem to mind. Take a look.
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
So he continues to read that dumb ongoing statement from a paper, yet he did not push back at all against loosening financial conditions. He didn't seem to mind, folks. And then what about jolts? Is that a problem? Not anymore. Take a look.
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in jolts has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
So he acknowledged that the job market is still too hot, but he doesn't see a problem in that anymore. Why? Because he actually now believes in the soft landing. Uh-oh. Which leads us to what, Jackson Hole? What are you talking about?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. We can now say, I think, for the first time, that the disinflationary process has started.
What inflation? We are in disinflation, says Powell, and he sees disinflation going on without hurting the jobs market. Soft landing, baby. This is not Mr. Payne from Jackson Hole. Remember Mr. Payne? This is Mr. Transitory. Mr. Transitory is back. Take a look.
My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome.
Now, of course, this is a stupid fantasy. All what Jerome Powell ensured is that the market will rally, and this rally will suck more poor souls who will believe that the bear market is over and this is a new bull market. You are already hearing it all over the place, and you're going to continue to hear it in the days to come. Bear market over, this is a new bull market in the making. But he also ensured the revival of inflation, which will end up killing the new bull market narrative. There has not been a single instance of a major inflation cycle reverting back into into expansion. Never. Every single one ended in a recession. You don't have to be a genius to figure out why. Inflation erodes savings and consumer spending power. And it also erodes corporate margins, as we've been seeing throughout this earnings season. The cumulative effect of that is a recession. Unfortunately, Powell, with the callous take today, ensured that stagflation, which is the phase that come in between the transition from inflation into a recession, will prolong. And the longer stagflation persists in the economy, the deeper and more damaging the recession that will follow. And with that message out of the way, let's move on to cover the stock market information today. We begin with the closing of the indices, and here we go. The Dow Industrial Average closing flattish, up by 6.92 points or a gain of 0.02%. The Nasdaq, on the other hand, leading the pack with gains worth 231.77 points or a gain of 2% even. The S&P 500 also in the green by 42.61 points or a gain of 1.05%. What about the sector's performances today? At number 1, capturing the gold medal, technology. Number 2 for the silver, cyclicals. Number 3 for the bronze, communication services. The laggard of the day is energy. So we have risk on, but we have conflicting signals here. We know that the reason behind the rally is not what Powell said or did not say. From a technical perspective alone, the reason behind the rally is the drop in the dollar. So we have somebody lying here. Is the dollar playing possum and energy seeing through that and therefore energy is down? Or is the drop in the dollar legitimate and what technology and risk-on segments did today is the correct response? If that is the case, then we have a lag in energy. We will see energy playing a comeback tomorrow. When it comes to the advance to decline ratios, the NYSE 69% advancing versus 30% declining. The Nasdaq 67% advancing versus 30% declining. When it comes to futures, commodities, again, mixed signals today because the dollar was down, Japanese yen was higher, the euro blasted higher. So in the FX market, we have a signal of risk on, meaning go ahead and buy commodities. And indeed, gold confirms that because gold was up. But notice the conflicting messages here. Copper was down. Dr. Copper, the most sensitive commodity to the US dollar, was actually down. Energies were down across the board. So somebody's lying here. Either the dollar once again playing dead, and we see it bouncing back tomorrow. In that case, gold is lying. Energy and copper, they were telling the truth. But if we see the dollar continuing to move down, then the opportunity becomes in copper and energy, meaning gold was actually doing the correct reaction. And then the opportunity becomes in copper and energies playing catch up with gold because the dollar is indeed going down. So keep that in mind. On to the big casino, the options market, and what do we see here? The volume all in all was down, believe it or not, so we don't have a confirmation from an options market perspective that this rally is going to stick. Otherwise, we would have seen an explosion in volume, a lot of calls being bought. This is not the case, although we've seen it in few names. Chiefly, number 1, the hottest table by far, Tesla, with around 1.2 million contracts traded today. About 54.5% of those were calls. AMD at number 2, with around 1.1 million contracts traded today. About 59% of those were calls. And if AMD is pumping, why not pump Nvidia too? Although usually when you see a name pumping higher and the name that did not report pumping higher along with it, usually when this name reports earnings, it goes down. In this case, Nvidia is riding on the wave of AMD, which was not a good report, by the way, which means that perhaps if the rally continues all the way till Nvidia reports, Nvidia becomes at the risk of pulling back. But in any case, at number 3, Nvidia with around 600,000 contracts traded today, about 54% of those were calls. On to the unusual activities that took place in the options market today, and we begin with the ticker FDX. We have bad news for FDX FedEx. I'm going to talk about that in the heat map analysis, but we have somebody here betting that FedEx will go down, and they bought the 185 puts for the expiration date March 17th, with expectations that FDX could move down and lose more than 9% of its value by then. They paid around $3.75 a piece, tenor. This trade, all in all, spending around $7.5 million. And then what about the IWM, the Russell 2000? Everybody today is assuming that we're going to see an orgy in the stock market from this point on. We're going to blast higher, baby. Nothing is going to stop us now. But a lot of folks are taking the other side, and you will see that they will be proven right. Here, we have somebody fading the rip in the IWM and buying the 171 puts for the expiration date March 31, with expectations that the IWM could move down and lose more than 12.5% of its value by then. They paid around around $1 a piece. Tanner, this trade all in all spending around $2 million. And last but not least, what about the ticker AMD for, you guessed it, AMD? Again, somebody fading the rip big time this time around. They bought the 77 puts for the expiration date February 24th, with expectations that AMD will move down and lose more than 9% of its value by then. They paid around $1 a piece. Tanner, this trade all in all spending around $1.5 million. On to the heat map analysis. What do we see today? Obviously, risk on. Jerome Powell gave us the green light for risk on. The problem is the climax is coming soon. But for now, we see technology moving higher. We see chips leading the pack. We see communication services, Meta, Netflix, Google all moving higher, along with the reopening / cyclicals all pumping higher, led by Amazon, Tesla, and the Chinese names. When you have risk on, no love for value, folks. No love for big pharma, no love for the consumer defensives, no love even for energy. But you gotta watch energy carefully now. Is energy right or chips, technology, risk on right? It all revolves around the dollar. Energy is saying the dollar played possum today. Risk on, technology, RKKs, the reopening names are saying no. The move down in the dollar is legitimate and it will continue. And in that case, the opportunity becomes buying the dip in energy. But if energy is telling the right side of the story here, we will see the Dixie rebounding tomorrow, and we realize that today was just a knee-jerk reaction, then the opportunity is in shorting risk on. And again, folks, we're not talking about making lower lows right now. Jerome Powell made it clear. We're not going to see lower lows until the second half, but it becomes in playing the pullback, playing the climax. Watch the dollar and you're going to know exactly what to do. Either you buy the dip in energy tomorrow or fade the rip in technology. Now we have notable movers today, and we talked about FedEx, so let's talk about it right now. And this relates to the tsunami of layoffs that we're seeing in the economy right now. FedEx is cutting its global management jobs by more than 10%, and according to the CEO, that is to make it a more efficient and agile organization, quote unquote. And I say, hey, Mr. FedEx, how about you start cutting your own salary? That'd be nice too. But more in the tsunami of layoffs, we have Revvion also cutting 6% of its workforce. On top of that, we know that Intel, the layoffs are coming. TikTok. So the CEO is now prepping all of these employees for the upcoming tsunami of layoffs at Intel by taking about 25% pay cut out of his insane, overinflated, unbelievable salary. And I say after the worst report in history, this man has no shame at all, and he should resign effective immediately. And here's some good news for the defense contractors. Germany is now in talks with several defense manufacturers to build a multi-layered anti-missile shield that could cost as much as 17 billion euros. War is good, baby. Keep them coming. In the coffers of Lockheed, Raytheon, General Dynamics, we want more and more of that German cash. And oh, by the way, more and more German cash in buying U.S. natural gas, not the cheap one from Russia. So when Chancellor Scholz talks about, oh, Germany's going to have a soft landing, the worst is behind us, what the hell are you talking about, buddy? You're paying more. You're gonna pay more. The luxury life that the German population enjoyed in the last few years, well, that's coming to an end now because your government's going to pay more in defense and more in buying natural resources. And that means less money for you. Congratulations. On to the heat map analysis. What do we see here? Obviously, the risk-on rally is led by growth, and we see growth outperforming value, be it both in the green. We see also the risk-on small caps, high beta names moving higher, and therefore the TNA also appreciated by a lot, almost 4.5% worth of gains today, although when I saw that it was up by almost 7%. Now, it could rebound higher tomorrow, but the play is over, folks. I'm done with it. That's it. Now, the origin behind the risk-on rally today is the dollar moving down. Now, we know when the dollar moves down, this is good for what? Chips, gold, technology, small caps, all moving higher. But it's also good for energy. Yet energy was the laggard for the day, which again sparks the conversation. Was the dip today in energy an opportunity to buy? That depends. Whether the dollar will continue to move down, was today's move a knee-jerk reaction? But you know what else moves higher when the dollar goes down? How about international markets, but specifically the developed and emerging markets, including Chinese markets, and therefore the FXI, MCHI, all blasting higher. Now, when we talk about international markets, we cannot help but to talk about India. What's going on with the Adani disaster? Here's an update. was a lot of anticipation in the upcoming share sale by Adani worth about $2.5 billion. But of course, now that the shares were going down and we have accusation of fraud against Adani by Hindenburg, it doesn't look right, it doesn't smell right, it looks like a pump and dump, it looks like no respect at all for the Indian mom and pop retail investor, and therefore Adani was forced to call off the share sale. And immediately shares of Adani collapsed, down by almost 27% in a single day. And now we have more evidence that the Adani group likely bought into its own $2.5 billion share sale. Here we go, more corruption, more problems for Adani. This is not going to stop anytime soon. And by the way, do you guys want to hear more about this story? Do you want us to do an in-focus segment on what's going on with Adani and cover the whole accusation by Hindenburg? If you'd like us to do that, let me know in the comment. But for now, I'm moving on to the charts analysis, and we begin with the SPY, the S&P 500 30 minutes chart. What do we see here? The closing candle not looking good from the 30, from the hourly, and of course the hour size overextended. But we know what happened after hours with Meta. And if Meta moves higher, opens higher, it means Amazon will open higher. It means Apple, Microsoft, Tesla, the rest of them also will open higher, which also means the SPY will open higher. But remember, and you're not going to understand it right now. You can say, Maverick, I don't want to hear from you anymore. This is a bull market, higher we go. Okay, no problem. Go ahead, buy some calls, buy some shares, please. Do me a favor. But what I'm betting on is the buying climax will hit soon. Is it going to happen in a gap and crap right away in the morning? Perhaps. Is it going to happen after one of these earnings come out disappointing, such as Amazon, Apple, or Alphabet? It's one of the two. But my bet is we will see the buying climax concluding by the end of this week. And if that is the case, by the end of the week, we will see the SPY losing 410 as support. Now, if it closes above 405 by the end of the week, no harm done. Even if it goes down all the way to 398, no harm done because we need that pullback. But remember, the pullback will be momentary. The dips will be bought because we have to close the gaps above. And today, Jerome Powell told us, hey folks, go ahead and close the gaps above. And the confirmation of that would be further weakness by the dollar tomorrow. If that is the case, whatever dip happens in the SPY and the Qs will be bought. We go higher, close the gap, and then the CPI shocks us all the way down in a flush down, and everybody's going to talk about, oh, what happened to the bull market? It's over. I guess we're back in a bear market now. Well, remember, the guy you're listening to right now told you this is what's going to happen. Now, if we zoom out to an hourly chart, you can see that 410 is an important level as support and resistance. And I believe that the SPY did not provide any piece of evidence right now to be trading above 410. So what will happen, whether we gap and crap or not, I believe we're going to lose 410 by the end of the week, and we have to defeat 410 in a proper way, meaning more organic buying, more support, not these gamma squeezes and options market bullshit. We have to see folks actually buying the underlying stocks. And here's the daily chart for the continuous contract for the S&P. What do we see here? Number one, it is above the important support, 4,102. You can round that down to 4,100, which I believe we're gonna lose by the end of the week. For now, the hour side, the MACD indicators, all positive, all firming up, and we have plenty of room for the rally to go a little higher. Maybe all the way to the next resistance that we have at 4,180, or even let's round that up to 4,200. And then comes the climax, whether that happens due to earnings bombing or due to the technicals alone. When we see the pullback, we lose 4,200 support, and maybe we even lose 4,100 as support. And then you're going to start to see the narrative changing, where the bulls are happy today, not so happy. The bears are not happy today, being happy again. But a reminder, the dip will be bought. We have to close the gaps above now. What about the Qs? 30 minutes chart, what do we see here? The pump continues in the aftermath of the FOMC. Now the chart is trading above the next resistance, which is 300.72. Now we know that the RSI is overextended by a lot, and every single time it traded at these levels, it pulled back. So the question now becomes, in the aftermath of Meta, is it going to happen in a gap and crap? I think there is a high possibility of that happening, but the bigger possibility is the rally continues tomorrow, and then we see something bombing after that. And the best possibility is Amazon bombing. So if you see Amazon rallying 5, 6, 7% tomorrow, heading into earnings, it is a no-brainer for me. You do whatever you want to do, but it's a no-brainer for me. I'm going to buy puts in Amazon. And when the climax hits, we will lose 372 as support. But again, a reminder, so long as the chart is trading above 280, the likelihood is we're going to move higher. We're going to close the gaps above. And here is the daily chart for the continuous contract for the Qs. What do we see here? Above the important number of 12,339, so there is no risk of a double top for now. That's gone. And the rally wants to go higher, and it can go higher. Looking at the RSI and the MACD, there is still room for a little more here. And the next resistance, if that happens, becomes 12,766. Now, what I'll be watching for is, will the weekly closing be below 12,207, meaning a reversal, or will it be above 12,207? We got a couple of days, and a big move could be happening. What about the IWM, the Russell 2000, 30 minutes chart? What do we see here? Also popping higher, no surprise here, and it got almost to the resistance at around 198.5. But the candle looks bad. However, with the meta pop, the assumption is the IWM will also pop. The question becomes, is it going to stop at 198.5 and then reverse? Will it reverse before the Qs? These are the kind of leading indicators that I'm looking at. The RSI is overextended. It is at the risk of a pullback. It will pull back. No doubt about it at all. Dixie, a daily chart, what do we see here? It went down in the aftermath of the FOMC. Not quite down all the way to the support of 99.9. The RSI remains oversold. The MACD indicator, believe it or not, remains positive. So there is a risk here that what we've seen today was just a mere knee-jerk reaction, aka a trap. But that will only be the case if we find out that the dollar did play possum today. If that is the case, you should see as soon as tomorrow the dollar rebounding higher, the narrative changing. You're going to hear people in CNBC saying, oh, but Powell said ongoing rate hikes. That sticks in my mind. I can't get it out of my head. Then you see the dollar moving higher, and we all got duped today. And if that is the case, gold is going to flush down. But if the dollar's move today is legitimate, then gold should be moving higher. But am I chasing gold at this point? I don't see it for some reason. With these technicals, with the overextension in these technicals, in the daily chart, RSI, MACD, not buying here. If I get a confirmation that the dollar is going down, then the opportunity is in the laggard, which is oil. Oil went down today. See, we have divergences between gold, oil, and the dollar. Somebody's lying. We'll find out tomorrow. And here's the 10-year yield, back below 3.5, but it remains once again in positive divergence in the RSI. It remains in positive momentum territory in the MACD indicator. So if today's action was a trap, you see yields moving higher back above 3.5 by tomorrow. And that will only happen, by the way, folks, if we see a digestion, meaning, okay, we looked over the data and what Jerome Powell said, and now all of a sudden we're hearing something different. I don't see why the market will revert at this point. I think Powell was clear. He was not bothered by financial conditions loosening. He was not bothered by the jolts. I think I heard enough here. But it could also be the market's ability to say, okay, the Fed is making a mistake right now, and we will see a rebound in inflation, and therefore we got to buy the 10-year yield right now. We got to buy the dollar right now, which means pushing the TLT down. So we have to wait and see what happens tomorrow. Forget about Meta, forget about Apple, forget about the Qs. What do you need to watch in the morning immediately? The first thing in the morning, yields, the bond market, the VIX, gold, the dollar, most importantly, and oil. If we have a confirmation with the dollar moving down, so far so good. Nothing changes. But if the dollar rebounds, we got a problem here. We got to have pies all over the place. But here's the TLT today. Still a negative divergence in the RSI. Still a weakening momentum in the MACD indicator. So we're not buying the move today until we get a confirmation. The confirmation would be closing above 109.5 by the end of the week. Otherwise, if this move is not legitimate, if this is a knee-jerk reaction, then yields pop higher above 3.5 tomorrow, and we see the TLT moving down. And therefore, be careful, folks. I know a lot of you already made their conclusions. This is a bull market. Buy the TLT, buy the Qs, buy this, buy that. Be careful here. We have seen many times where the market does knee-jerk reactions in the aftermath of the FOMC. And then the next day, we hear a conflicting narrative where folks talking about, oh, we thought he said this, but now we think he said that. So I'll give it a day or two to figure out whether this reaction is going to stick or not. Watch the dollar. That's the most important one. And by the way, watch the VIX. 4 hours chart, it is pretty much at the support for around 18. Is it going to bounce tomorrow? If I wake up in the morning and I see Meta up 20%, Amazon up 5%, Apple up 2%, Qs up 3%, but I see the VIX also moving higher, I don't need to see any more. I know the selling climax is coming. I know for sure, 100%, to buy puts in the Qs, to buy puts in Amazon, etc., etc. But if the VIX weakens further and we see it at 16, 15, then the market is saying, hey, let's just close the gaps above in one shot. Let's just do it right now. Let's have the SPY rallying 3%, 3.5% by the end of the week. Let the NASDAQ close the gap above. And by the way, that should encourage bears to be more active. And the reason is, for now, bears have short-term charts being overbought, but the daily's not quite there. Certainly the weekly is not there, but if we go in one shot and we close the gaps right away, the dailies would become way overbought. The weeklies become way overbought, and then it becomes a no-brainer. And in reality, the bullish scenario is what I'm anticipating, which is we see the buying climax happening right away. We see a pullback in the short run charts, the 30 minutes, the hourly, even the daily. We see pullbacks to fix these overheated readings in the RSIs, and then the dips are bought right away. We see the weekly charts moving to close the gaps above. That would be the bullish scenario. At the end of the day, everything is going to reverse because the next reading of the CPI will be hot. It will move higher month over month. But if you happen to be a bear, you would rather see the market just get it over with, get really hot, close these gaps above in the weekly, so we don't have to play the game of, oh, here's a pullback, the bears get sucked again, and then the dips are bought, and then we see here we go another reversal higher on the weekly charts to close the gaps above. Maybe I'm just overreading here on the VIX, and it's just going to be simple. We're going to see the VIX popping higher right away in the morning. I'm just laying out the possibilities for you. How about Apple? 30 minutes chart, what do we see here? Popping higher, no surprise here, above 145, but it did close the gap, but it did not close the day above the gap. Is it bad? Yes, it is, technically speaking, when you have a gap fill and then you close below the gap. But on the other hand, it did close above 145. So we give Apple the benefit of the doubt. Now that Meta is trading higher after hours, the assumption is Apple will challenge the highs from which it reversed the move down. So would not be surprised to see Apple gapping, and then it comes, is it going to crap along with the rest of them? Or do we see the rally continuing all the way till earnings, and then one of the three bombs, Apple, Alphabet, or Amazon? We see the buying climax, we see the pullback that I'm talking about. Tesla, an hourly chart, what do we see here? The bull flag is playing out, and it made a new high above 179, and if this pop continues, for whatever reason, Meta's rallying higher, the assumption is Tesla's going to open higher, then we have a gap fill at around 194.55. Now, if we get there, the assumption is we're going to see a stampede on the 200 call, which could initiate a gamma squeeze all the way till 200. If we get to 200 on Tesla, again, I'm not telling you to do anything at all. I'm just saying this is what I'm going to do. I'm going to be buying puts with both hands. And here's another important chart you got to pay attention to closely, along with the Dixie, along with gold, along with oil, the VIX 10-year yield. Forget about the indices. They mean nothing right now, but this is an important one. Bitcoin. Here's a daily chart that did not make a higher high today. What's up with Bitcoin? Now, it could move higher tomorrow and problem solved, but it got to get out of this consolidation zone. It got to pop higher to say, okay, we're in the clear. But folks, let's be honest here. The RSI is way overextended. The MACD indicator, way overextended. It is already at bearish momentum territory. Now, I know after the action today in the FOMC, you're going to say, hey, Maverick, the technicals mean nothing. The RSI means nothing. The MACD means nothing. It's all about the mania. Carvana will go back to 20. RKK will go back to the highs. I understand why the sentiment sounds like this right now, but the sentiment comes and it goes. The technicals remain in play forever. The technicals remain a fundamental piece of stock market analysis. The sentiment swings both ways. Today we're bullish, tomorrow we're going to be bearish. But the RSI, the MACD, why would they be wrong right now? All what they're telling you, they're not telling you to sell or buy. All what they're telling you is the risk versus reward says you don't want to hop in here. Even if this move moves a little higher, the risk is to the downside. I'd like to buy charts when the RSI is oversold, not overbought. Maybe I'm just crazy. Now, all eyes will be on Meta, so let's look at that one. Here's a weekly chart, and this is what I'm talking about when I say, hey, the bears should be hoping for a one-shot rally. Get it over with. Because when you look at the MACD and the RSI on the weekly charts, they still got plenty of room to go. On the hourly, on the daily, not so much. And therefore, I say pull back, then dip buying, and higher we go to close the gap above. Then CPI comes out, and down we go again. But if you are a legitimate bear, you should be hoping for, let's get it over with. Go all the way, close the gap tomorrow, by Friday. And that makes it easier. So we don't have to guess about, oh, pull back, then they buy the dip again, then we move higher, then we flush down. And this is illustrated right in front of you by the RSI and the weekly chart of Meta. Now, the immediate resistance is the Fibonacci of 155, but the chart is already trading above that, so we have 200. And of course, they're going to stampede and buy the 200 calls. I'll be watching how the options market reacts. If we don't see pushback, if we don't see folks buying puts in Meta fading the rip, then the likelihood is it goes to 200. But I do have my number from Fibonacci's side. My number is 183.85. If it opens in or around this number, I'll be looking at the chart's behavior. From the hourly perspective, from the daily perspective, the chart will become really, really overbought. If I see algorithmic reaction in dumping the stock at 183.85, if I see the human being who've been long Meta taking profits right away, it's going to be a no-brainer. Meta is going to stop at 183.85. Perhaps you want to sell the 200 calls credit spread this time around to capture the implied volatility. But if it goes above 183.85, then my assumption would be we got to look at 200. It's going to make it to 200, and then it stops and move down. Anyhow, moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? We have initial jobless claims along with unit labor cost and factory orders. Now in the earnings calendar, we have the busiest day of the week. I believe we have Alibaba in the morning. I'm not sure if it did report today instead. Let me know in the comments. But I believe it is tomorrow. And then we have Merck, Eli Lilly, Hershey's, Ford, and the WWE. But most importantly, after the bell, we have Starbucks, Amazon, Qualcomm, Alphabet, and the big kahuna Apple. Folks, what a day it was, but it is in the past now. We have to look forward. We have to look at earnings. We have to look at the technicals. We have to look at the macro data, what it indicates regarding the rebound in inflation. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. Good night.
You're a very important piece of this puzzle.